Okay, guys, in this video, we're going to talk about debit vertical spreads. Now, when we talk about spreads, it sounds like it's some like advanced, like magical word, like, oh, he's buying a spread, he's selling a spread. Well, it doesn't really mean anything. All it means is that there's multiple legs to that option strategy. So instead of just going in and just buying a call or buying a put, which we already know how to do, what we're going to do is we go in and then we sell a call against that call, or we sell a put against the put, or we buy a put against that call, or there's multiple things that we can do that's considered a spread. It just means that there's multiple legs or multiple things kind of going on all at once in this one strategy, and that would be considered some sort of spread. Okay, so what's with this debit vertical? Well, debit verticals are usually the first spreads that people learn how to trade, because if we already know how to buy a call and buy a put, which we do, that means we're already halfway there. So we're going to talk about how these work and then how we would actually utilize these spreads, vertical spreads, in real time. So we're here in our Apple April expiration. So we're going to go in and we already know how to buy a call. So we're just going to stay on the call side here. So everything we do for the call side can be used for the put side and vice versa. So we already know how to buy a call. So let's just say, we're going to stay in the money. We want, we want to be above 50 delta. So here's a 57 delta. We're in the money, have some intrinsic value here to our call. We're going to buy this 120. So we already know that if we purchase this 120 call, you can see here, it's going to cost us $4. Our theta is -7, which means that each day we're going to lose $7. Our delta is 56. So our exposure to the upside is really high here. So that means each dollar move Apple makes, we are going to either be making $56 or losing $56. And we also can see our probability of profit here, which is 37%. Now, if we look at our break evens here, you can see that because it's going to cost us $4 to purchase this call, our break even is going to be our strike price plus what we paid for that options contract. So in this case, it's going to be $4 plus 120, and that gives us our break even of 124. So we need Apple to close at least above 124 for us to break even on this, to make even 1 cent on this contract. Now, how do we adjust all of this, and why would we want to make some sort of spread against this? Well, what we can do is we can come in here and we can say, you know what? To reduce our exposure in here, reduce our theta, reduce our max loss, we can actually sell a call against this. So we can go in and we're going to sell this 122 call right here for 278. So we're going to go ahead and click on that. So we're going to sell that, and you can see now that our probability of profit increased to almost 50%. Our delta drastically got reduced to only $9, and our theta is virtually zero. But you can see that our max loss and our max profit is only at 94 here, and our max loss is 106. Now, how do we calculate our max loss and max profit on debit strategies? Well, it's going to be the width between your strikes here, and it's going to be subtracted by what we're paying for this spread. So the width between these two strikes here is going to be $2. So that's 200, all right, because it's options, everything's times 100. So this is 200 right here. So 120 or 122 minus 120, that's 2, it's 200. And we are actually purchasing this for 106. So 200 minus 106 gives us 94. The most we can make on this would be 94 cents. And that is if the stock expires above 122, we are going to make that full 94% profit. Now, our $94 profit. You can also see here where this green mark, let's go back here for a second. You can see that our break even was at 124. And as soon as we sold this 122, our green went all the way down here. Well, that's because our purchase price now is much cheaper. It's not $400 anymore. We're paying basically $100 for this. So our break even is just above 121 now. So what we did with our debit spread here, this is a vertical debit spread. So all we did is we sold a further out of the money call. And you can do this on the put side too. So wherever you buy a put, just sell a further out of the money put, and that is going to be a debit vertical. And so again, what we did is by selling that further out of the money call, we reduced our max profit, reduced our max loss. Our theta went down drastically to zero. So instead of losing $7 a day, we're losing basically 10 cents a day. and our delta exposure to the long side got drastically reduced as well. So as before, where were we? We were right around 56. So every dollar move that Apple made, our options price would be change. The change of our options price would have changed by $56. Here, it's only going to be $9 now. And what else we did is that our probably a profit was increased. Now you can do these debit spreads anywhere. So there's really no right or wrong way to do these, but I will show you guys that the further in the money you get, the higher your probability of profit will be. So you can see your probability of profit went up, but you're paying more for this and you're making less. So you can see that we're paying 127 for this and we can only make 73, whereas it's the same, it's still a $2 spread, right? And we have a higher probability of profit, but we're going to make less. Same if you go further out of the money here. So we can kind of scroll these down. Let's see, we'll go to 125. We'll do 125, 127 here. And you can see that now our probability of profit's less, but we can make more and it's going to be cheaper for us to play this. So if you guys want to come in here and you know what, instead of just purchasing a $100 call here, you know what I mean, and just kind of YOLOing, if I make any money on it, cool. If not, it is what it is. Well, you can actually turn this into some sort of a spread. So you can come in here and say, you know what, I'm going to sell this 128 against it, and now I'm only YOLOing $20, even though I can only make 80. But I feel better YOLOing 20 rather than a whole 100 and just throwing it away. Your probability of profit is basically the same. So you can see 25% probability of profit here. Oops. You delete this and you have 22 probability profit. So you're probably, once you get way farther out of the money, your probability of profit is basically the same no matter if you spread it out or not. So sometimes it is a little bit better to kind of spread things out, but really the correct way, I will show you guys the correct way of like, this is how the big boys trade debit spreads, is they'll go in here and they'll purchase something in the money. Okay, so something always has to be in the money. And then remember, we talked about intrinsic and extrinsic value and how all those are going to come into play when we're looking at these advanced strategies. So whatever our intrinsic value is, which is just our strike price minus where the stock is right now, or the stock, sorry, I got that backwards. Wherever our stock price is minus our strike price. So our stock's trading for what, 121.11 right now, let's just call it. We subtract that minus our strike price, so around $1.11. So we don't want to pay more than 111 for this debit spread that we're getting ready to put on. So that's our intrinsic value, is 111. So when we try to sell, let's go to this 122 real quick. We'll sell the 122 against it and see if it's going to be less than 111 to pay for this. And it actually is. So this would be a correct way when you're talking to the big boys when they're playing debit spreads, how they do it. It's always one in the money, or you buy in the money, you sell out of the money, and you don't want to pay more than your intrinsic value of your long option. And this would be a perfect example right here. So we want to keep it below 111 because that's our intrinsic value, and we're at 106. So this would be a great debit spread if you're trying to play them, I guess, in quotes, the correct way. But there really is no correct or incorrect way. It's whatever fits you guys, your accounts, and your risk profile. But again, debit spreads are just a great way to reduce your risk and exposure, yet you're going to be limiting your profits. So your probability of profit will in turn increase just a little bit, depending on if you're going to go further in the money, further out of the money, whatever. And your delta is going to decrease, your theta is going to decrease, your max profit will decrease, your max loss will decrease, but your win rate will increase, and your probability of profit will increase as well. So all things to kind of know when you're playing these vertical debit spreads. And once you kind of get the hang of these, then you're going to have an easier time getting into these larger strategies. So again, you're just buying a call and then you're selling a further out of the money call, buying a put, selling a further out of the money put, and that's all a vertical debit spread is. Okay, guys, thanks for watching. Make sure to check us out on our social media. We have attached the links to our socials in the description. We also have a swing trading service if you're interested. There's more information in the description below.